Stock exchange is a platform where willing buyers and sellers transact in various financial securities, one of which is stocks. These transactions take place in an organized manner within certain rules and regulations so that the risk of settlement of funds and securities is minimized. They also stipulate rules for listed companies to protect investors against any wrongdoings by the company. Any person who wants to buy or sell stock can only do so through stockbrokers. Stockbrokers are registered members of the exchange. They are often referred to as trading members as well. Trading members need to fulfill certain minimum requirements for capital, qualification, net worth, and other criteria. Members of the exchange can either be trading members, clearing members, or both trading and clearing members. We will look at this later. Stock exchanges monitor members for their positions, capital, and compliance to various rules. Stock exchanges also provide facilities for issue and redemption of securities and corporate events like payment of dividends. Stocks are not the only securities that get traded on exchanges. Apart from stocks, it is common for securities like corporate and government bonds, currencies, and mutual funds to also get traded on stock exchanges. Apart from this, certain derivative instruments like futures and options also get traded on exchanges. We will understand futures and options in later videos. For now, let's understand what are the advantages of trading on exchanges. You might wonder why investors do not trade with each other directly instead of trading on exchanges. One big reason you should trade on exchange is because by trading on exchanges, you enjoy certain benefits due to regulatory and redressal provisions of law. By trading on exchanges, investors get a liquid market to transact, which ensures that they get the best possible price for their trade. It also ensures that your trades are completed efficiently as you don't need to search for counterparties to transact with. All investors trading on exchange are required to comply with the Know Your Customer or KYC norms, and everyone has to trade through a broker. The brokers provide investors with market information, news updates, research reports, and other analytical tools to analyze securities for buying and selling. For retail investors, this information is not readily and cost-effectively available otherwise. Stock exchanges also reduce the settlement risk between various parties. Settlement risk is the risk that one of the parties to a trade may default on its obligation to deliver a security or cash as per the trade. Stock exchanges have risk management systems in place to ensure that parties fulfill their obligation. In order to manage this risk, the stock exchanges operate with various intermediaries. In our next lecture, we are going to look at the life cycle of a typical transaction on the exchange and also learn a bit about the various intermediaries associated with the exchange. There are three phases in a secondary market transaction. The first phase is trading. This is where the actual buying and selling of securities happen. Exchanges take various buy and sell orders from different people on their electronic order matching system. Then they match the various buy and sell orders to execute trades. So for example, if these are the various buy orders on a security and these are the various sell orders, then the matching system tries to see if there is a match between a buy and a sell order at a particular price, and if so, fill both the orders. Through this process, the trade is executed speedily, efficiently, and anonymously. All investors route their order through brokerages. Brokerages collect various orders from investors and route it to the exchanges. As a retail investor, the intermediary you will deal with directly is the broker, and the broker in turn interacts with the exchange on your behalf. The next phase is clearing. Once two orders match, a trade is executed. This trade has to go through what is called a clearing process. Clearing process is the process of identifying which securities and in what quantity is owed to which buyer. The clearing process also identifies what amount of payment is owed to the seller for this transaction. So if an investor A buys 100 shares of company X at $10 each from investor B, the clearinghouse does the math and determines that investor A is owed 100 shares while investor B is owed $1,000. In case the buyer or the seller perform multiple transactions, then the clearinghouse identifies all the securities owed to or by them and also all the payments owed to or by them. This clearing process is managed by an independent entity known as the clearinghouse. Once the clearing process is complete, the next phase is settlement. On completion of the clearing process, it becomes clear what security is owed to which investor and what payment is owed to or by each investor. The next step is to fulfill these obligations. The settlement process is the process where securities and payments are made to respective investors. Once the settlement process is complete, the buyers receive their security and the sellers receive their payments. Various intermediaries play different roles in a security market transaction. The first intermediary is the trading member. Trading members are your typical stockbrokers and their affiliates, also known as sub-brokers. Every investor is required to route their transaction through one of the trading members. A broker can become a member of the exchange only on fulfilling certain minimum requirements for capital, qualification, and net worth, among other requirements. The exchange closely monitors all the members, and all members are required to fulfill their obligation to their clients. The second intermediary is clearinghouse. Clearinghouse conducts the clearing process. They are independent entities who act as counterparty for all trades executed on the exchange. This means buyers transfer all the funds of the transaction to the clearinghouse and sellers deliver all the securities to them. This of course happens through the broker. Clearinghouse employ risk management systems to reduce the settlement risk between parties. Another intermediary involved in transactions is the depository and depository participant. Like you keep your money with a bank, you are required to keep all your securities with a depository. A depository maintains a record of all the securities you own. Hence, depositories also facilitate the exchange of securities. Only the securities that are held in electronic or dematerialized forms may be traded in the secondary market. When the securities are issued through the primary market for the first time, the issuer deposits the security with the centralized depository. From there on, the record of which owner owns which security and in what quantity is maintained in the centralized depository. Depositories appoint depository participants who act as intermediary between the depository and the investors. So every investor is required to hold a demat account with a depository participant. The settlement of securities is done in this demat account. On completion of a trade, the depository participant then informs the centralized depository about change of ownership. The payments for respective trades are settled through pre-identified clearing banks. Practically, your broker manages the nitty-gritties of this process for you. Another intermediary that is mostly employed by institutional investors is the custodian. A custodian is a bank which holds funds and securities on behalf of large institutional investors like mutual funds and insurance companies. Custodians settle the secondary market trades and may also act as clearing members and clearing banks for the institution in order to manage the settlement of both securities and funds. A security represents terms of exchange between two parties. For example, a stock is a security which defines your percentage ownership in the firm. This security has no maturity date. As long as you own the security, you are entitled to a proportionate share in the profits of the firm. Securities are issued by different institutions like corporate, governments, banks, or other financial institutions. Securities are purchased by various investors who have surplus money to invest. Securities allow investors to convert their savings to financial assets that can provide them returns. The issuer of the security proposes the terms on which they are raising capital. The investor who invests in these securities has the claim to the rights represented by the security. These rights may involve ownership or participation in management or claims on assets. Stocks are not the only type of securities that get traded on exchange. Different types of securities belonging to different asset classes can trade on exchanges. The exchange decides which securities can be traded after taking due permissions from the relevant regulators. Typically, you will find that stocks, corporate debentures, bonds, government bonds, close-ended mutual funds, and currency futures get traded on the exchange. Also, derivative instruments like futures and options, which derive their value from one of these underlyings, also get traded in the derivative segments of the exchange. It is up to the exchange to decide which securities would have derivative securities also available to be traded on the exchange.